think he created an impact. He's leaving a good legacy behind.
As India bids adieu to Rajan, the 23rd governor can have the satisfaction of leaving behind some strong legacies. The most important one is convincing the government to give the RBI an inflation target of 4% plus minus 2%. The results have been convincing. Inflation has fallen from an average 10% in the 3 years prior to Rajan to an average 5 to 6% in the past 2 years. Besides, he has succeeded in shifting focus to the correct measure of inflation, which is consumer price instead of wholesale price, which is a long-term positive for policy making. Finally, the government is all set to appoint a monetary policy committee of 3 economists for a 4-year non-renewable term, which can ensure more independence to policy making. These may well be Rajan's permanent institutional contributions to India.
Rajan is, before I talk negatively about central bankers, but he's at least one who understands the problems. He's probably the best central banker in the world at the present time.
As a banking regulator, Rajan showed rare courage. He forced banks to come clean on bad loans that earned him much criticism and enemies in corporate India.
My name is Raghuram Rajan and I do what I do.
But as he leaves, Rajan can have the satisfaction that a large part of the poison is recognized. He has given many tools to banks to put back broken companies back on track or sell them off, though very few have worked. However, Rajan's contribution here is to ensure that bankers have begun to arm to his debtors and not the other way round. A third contribution of Rajan is giving over 20 banking licenses and putting the process of licenses on tap rather than once a decade as it used to be. Along with the unified payments interface, phone banks, Jan Dhan, banking and payment became much more inclusive under Rajan.
On the reform side, financial inclusion, I think it's an unfinished agenda. We need to do a lot.
In the past week, Rajan has hastily moved steps to force out a bond market by seeking to let RBI accept corporate bonds as collateral in its repo transactions. He has also mandated that companies with over 250 billion rupees of loans have to henceforth borrow from the bond markets and not banks. Both moves are fledglings and may be big items in the next governor's agenda.
Hello and welcome to Indianomics. That was the story so far. Now what's the agenda for the next governor? To discuss that, I have with me a star panel. Arvind Virmani, until recently member of the Monetary Policy Advisory Committee and former Chief Economic Advisor. Also, former RBI Deputy Governor Dr. K.C. Chakrabarty joins from London. Shyam, Srinivasan, Managing Director of Federal Bank, and the Head of Credit Business at Nomura, India, Neeraj Gambhir, have also joined. Thank you very much, gentlemen, for joining me. Well, first up, Dr. Virmani, what will be the agenda for the next governor on monetary policy? Will it be to bring inflation now down towards the 4% mark?
I think the primary and most important is to complete the institutional process, which is the Monetary Policy Committee, because, you know, when a new institution is created, traditions and ways of doing business have to be initiated. So how the governor handles the Monetary Policy Committee will set the stage for a long time. So in my view, that is actually the most important thing as far as monetary policy is concerned. More specifically on your question about the inflation itself, clearly the Monetary Policy Committee will have a much greater role than under earlier governors, and therefore that issue remains. I don't think it's any more urgent than it was. In fact, several people, including myself, feel that the target which was set for the end year of less than 5% will be attained. I think a lot of people have been misled by the short-term rise in food prices. But yes, people can have different views, of course.
Okay. Dr. Virmani, the other part of monetary policy, which probably will not be directly with the Monetary Policy Committee like yourselves, has been liquidity. Do you think transmission is something that would be the next point on the new governor's agenda?
Well, as I wrote in March of this year, I think the monetary aspects, I have argued for more than 10 years. In fact, when the Rajan committee report came out, that in a fragmented and incomplete market like that of India, you can't make the same assumptions that you do for the New York market or the London market, where you just focus on the short-term repo rate and everything else goes smoothly through the system. And yes, I think the lesson has been learned, so there will be much greater focus on what in the good old days or the bad old days used to be called money supply. I mean, you can put another name to it, liquidity or whatever, but I think, yes, there will be, and you're right, in some sense, how much emphasis to give to the repo rate versus this liquidity or whatever we want to call it will be an issue, yes. I think you're quite right, that balance has to be struck.
Okay, well, on that point, let me come to the bond expert in the team. Neeraj, Gambhir, what would you say is the agenda for the new governor in liquidity and in other aspects of the bond market?
So I think, Monetary Policy Committee, its constitution and its communication with the market, its style of operation, its overall area of purview. I mean, does it only, limit itself to rate setting, or does it also involve itself with how the liquidity and how the monetary policy operation is going to function is, I think, going to be something that market is going to watch with a very, very keen interest. It's also going to set the stage for, the next round of market rate movements. So that's clearly something which is the top of the agenda for the market to understand. The second thing, I think, which is slightly longer term structural reform, is, to my mind, creating capacity for in the bond market, especially in the corporate bond market, for the large issuers that are slated to come once the new rules set in. How do you sort of absorb that capacity? Where is the institutional capacity for that? So in that context, I think Reserve Bank stepping into the market and looking to buy corporate bonds for its own portfolio as a part of its open market operations is going to be a very, very important step. I think it's going to create some more liquidity into the market. It's going to bring some depth into the market. So I think that's, from a bond market perspective, the second most important agenda, I would feel.
Okay. Let me at that point get Dr. Chakrabarty in. Dr. Chakrabarty, a bunch of announcements have come on the corporate bond market, but all that will fall on the next governor, you think? Will it be very important that he has to negotiate with the government, get the RBI Act amended, and ensure that those repos start accepting corporate bonds? Will that be clearly one of the biggest points for the next governor?
Yeah, I think that is definitely a point. If you have to make the corporate bonds liquid, you need to amend the law. But how important it will be, I don't know. Because you see, I have my different take on the corporate bond market, because we have to find who will purchase this bond. If this is only dependent on the banks, then I don't think it is going to serve the longer term perspective. But definitely, if we say that this needs to be reformed, definitely it has to be on the agenda of the governor.
Yeah, I guess the governor here will have to play a very important role, probably in the FSDC or as the head of liaise with other regulators and ensure whether the PFRDA and the IRDA are able to cajole, more of those institutions to buy bonds. But Dr. Chakrabarty, even getting this large exposure theme implemented could be very important. You think here the governor is only the 23rd governor has only indicated the intent of the Reserve Bank that starting from FY18 banks should lend to already indebted companies with loans over 25,000 crore only with higher provisioning and higher risk weight. Is this going to be a very key agenda and not very easy to implement?
You see, look, what happened that this type of reform through that direction is very difficult to bring. What I feel that, look, what is the purpose of this reform? Is it we are trying to de-risk the bank, we are trying to reduce the exposure of the bank, or we are trying to bring the corporates to go to the bond market? I am not very clear about that. You see, I don't think that it will be an easy task to accomplish this thing, especially if we say that we have a financial system which is a bank-led financial system. In any case, banks have to take that risk so long as the financial system will be bank-led. Now, if the banks have to take the risk, now whether they take it through loan or through the bond, what difference it makes, at least I am not able to fully appreciate the things. But yes, if we have to bring the more corporate bonds more active, I think what we look into that, our assumption is that we don't have a bond market. I don't agree.
Okay.
Second thing is that who wants a bond market, we need to debate this issue. So this is not a part of this issue.
I think,
it remains an agenda, that much only I say, but
I take your point, sir. My issue
I have
is
a different take on
I agree with you. I agree with you. I mean, I accept the point you're making, but I think the effort was to ensure that banks are de-risked from these over-indebted companies to some extent, over-indebted groups, and that's why even exposure to single companies is getting brought down from 25% of capital funds to 20% of Tier 1 capital, and likewise for groups from 40% of capital funds to 25% of Tier 1. Shyam, come in on that. What's your sense? Is this a big part of the agenda? Is it unimplementable or very, very difficult to implement, as Dr. Chakrabarty says?
Yeah, I think, Latha, like Dr. Chakrabarty said, the crucial part is bringing in financial discipline. Now, putting a number and a date is only a direction to that. I am of the firm view that in passage of time over the next 12-18 months, this will get discussed many times over, because there are some real issues. And if the intent is to bring in financial discipline and make sure that banks are not overexposed to a particular customer, I think that's most welcome. But on the client side, you cannot limit the whole thing, because the second part of the market, A, is not very developed. B, the ultimate risk is still with the bank. So I think, in my view, the new governor or the new processes that will be viewed over the next 12-18 months will be informed by what happens in the market over the remaining period. Right now, the credit demand is low. The pickup in the market has yet not sort of very visible. So some of these may be more academic. But if indeed there's going to be great momentum, there's going to be a large demand for bank loans, and credit is going to be pick up in a substantive manner, this will get discussed quite profoundly. But having said that, bringing in discipline, increasing risk weights, ensuring that banks are not over-lending to the same client, I think that's all make eminent sense. So my guess is, and the new governor is a person who's done the infra business in his earlier life. So I think that he probably understands that and probably will make the necessary tweaks. And so I'm of the view that this will sort of evolve over the period of time.
Okay. Well, I have to take a break, but there are lots more things we will be discussing with our guests in terms of the agenda for the new governor, especially in the case of on-tap licensing, financial inclusion, and of course, the most important, disruptive digital banking. Back in a minute.